Hey guys, what's up? Alec back with the daily stock market, and look at that. Overall, pretty flat day in the stock market. However, we have some individual stocks up around 4%, like Alibaba. Alibaba did report earnings today. Disney reported earnings yesterday. We also had Sony and Roblox reporting earnings as well. So we're going to be going over some of those stocks. We're going to dive into Disney in this video. So make sure you buckle up, put your seatbelt on, like this video, leave a big thumbs up, subscribe on YouTube with post notifications on so you don't miss out on any future full-length videos on YouTube. And let's dive right into this. So yes, in this video, we are going to be talking about Disney and Alibaba stock, but let's talk about Disney stock first because they reported earnings yesterday. Disney is up 4.8% on the day at $91 per share. And in the past week, it's rallying just a little bit, up 5.9%. But obviously in the past 3 months, the past year, it is still down 18%. And if we look at the 5-year chart, that's when it really starts to get interesting because we can see they're down 20%, nearly 20% in the last 5 years. And they're actually lower. The stock price currently is lower than it was in 2018. In 2018, it was closer to $114 per share, and the only time it touched this low under $100 per share in the past 5 years was when the whole world was shut down due to the pandemic and the Disney parks and everything had to close. And that was almost, I'm pretty sure that was pre-Disney Plus on top of that. So Disney Plus wasn't even in the equation. The whole world was shut down. The Disney parks were shut down, the theme parks, and it has the same valuation it did when the world was ending at $85, $95 per share as it does today. So is Disney stock a good deal in the stock market? Are they still overvalued? What's going on? Let's get right into it now. In the past, we've made some videos about this stock. Buying at $85, $86 per share is a lot more attractive, but I think anything under $100 per share is fairly attractive. You know, there is a PE ratio of 38 currently on Disney, implying that it is currently could be a little bit overvalued with a market cap of 167 billion and could fall a little bit more. So yes, there is still risks going on with Disney, but I think it is a good stock for long term. Okay, so if we pull up Disney's income statement and look at their net income, let's formulate our own opinions on Disney. We can see quarter over quarter it's been growing and getting back to profitability in a strong way. Just reported 1.9 billion in net income, which is very amazing to see. Net income on the year was closer to 3.5 billion in 2022. So it's good to see that they're projected to keep growing on their net income. Remember, 2020 was the year that they reported negative numbers, and that was because the parks all shut down and Disney Plus really wasn't a thing back then. So it's good to see Disney getting back to profitability. That's one of the most important things. We can see that the quarter over quarter growth is somewhat growing as well. A little hiccup at the end of the year in 2022. If we look at Disney's revenue, we can see quarter over quarter, they're growing pretty great numbers, all right? We can see growing from 19.2 billion to 21.8 billion, growing 23% in a quarter, 26%, 8%, 7%, 13%. That's 5 straight quarters of revenue growth. If we look at the yearly chart, we can also see in 2018, remember the stock is the same price that it was in 2018 or lower, and today's price is lower than it was in 2018. It was only 59 billion in total revenue, and today it's closer to 82 billion in total revenue, showing that year over year consistent growth in total revenue. Total income is a different story, and that's what's a little bit shaky, meaning we want to see over 10 billion in net income here soon. As long as we see growth, 2.5 billion to 3.5 billion to 5 billion in 2023 and then 7 billion, that's going to be a very, very good sign for Disney. And if we scroll down to look at balance sheet of Disney, it's very pleasing and it makes me want to invest in them for long term. There's no real risk going on with Disney at all, especially at these valuations. The debt to asset ratio is only 46%, which is lower than the industry average. And we can see that Disney currently has $203 billion in assets and only $95 billion in liabilities. So it still has an extreme amount of money. It's not people shouldn't be concerned with Disney going underwater, going out of business anytime soon. It looks like a very healthy company in my eyes, and the chances of them selling the company to something like Apple is probably very low, especially considering that their balance sheet is a-okay. It's very healthy, and their income statement's very healthy too, showing those revenues growing not only year over year in the last 5 years, but also quarter over quarter on that revenue growth. Now, I actually pay a Premier's monthly subscription to actually see what analysts have to say about every single stock. And Disney, this is what analysts, we already made our own opinion on Disney, but let's have look at to see what analysts have to say about Disney stock. They have an average price target of $113 per share on Disney in the next 12 months with a high of 146, and the risk of Disney is closer to $76 per share. Okay, so that's why we are buying in the private group closer to $86 per share, because that cuts the risk in half. Now, in my personal opinion, I think $80 per share is the risk and the upside is closer to 146. So I think that 113, 115 per share is a good middle target and average return that should happen over the next 12 months, which would be a 25% increase of your money, by the way. Now, if we scroll down to see where these analysts are coming from, we can see TD Cohen at $94 per share, price target in the next 12 months. Matthew Thornton at 105. We can see other analysts coming in at 102, $128 per share. Goldman Sachs analyst reiterated it just yesterday. 128 price target in the next 12 months. We have 105, 135, but that's a one-star analyst, so I would take that with a grain of salt. Reiterated 2 days ago, a Citibank analyst at $125 per share, Wells Fargo at $146 per share in the next 12 months, and the list goes on and on. So as you can see, analysts are overall fairly bullish on Disney, and the risk versus reward looks fairly favorable for longer term investors that want to hold Disney stock for the next 12 months or so. Now, the next stock that we have to talk about is a Chinese-based company. It's Alibaba, ticker symbol BABA. You should all know them, and probably all don't love them because of a thing we're going to be talking about in a minute here. But somewhat the same story going on with Disney. A little bit of a rally today, up 4%. And in the past week and past month, they've rallied around 9% and 20% in the past 3 months. So that's not nearly as good as Disney. But if we look at the last 5 years, we can see the same story going on. Alibaba is down 45% in the last 5 years, and they're way lower than they were in 2018. In 2018, they went to $180 per share, and the lowest they touched was $132 per share for the next couple years, and they went as high as $300 per share. Okay, so only recently has Alibaba got to these low valuations to under $100 per share. Now, under $100 per share could be very attractive for something like Alibaba. If we scroll down, we can see that the PE ratio is currently 23, implying there's somewhat of a good deal at the current valuation just by looking at the PE ratio. The market cap is 256 million. And if we take a look at what the earnings, they just reported them today, the expected was $2.02, and they came in with a beat at $2.40. They also surprised in the last 5 quarters with a positive surprise on the EPS. If we pull up their income statement, let's start off with on a good note. We can see that their total revenue has increased significantly from 2018. It was only around $250 billion in 2018. Remember, the stock was priced closer to $170 per share, and now it's under $100 per share. Okay, so we can see that it grew from 2018 to 2020 by around 100%, and then it went on to grow again from $500 billion total revenue in 2020 to 2021, 40% growth that year. And we can see they kind of stagnated around $800 billion, almost a $1 trillion total revenue. So the net income must be spectacular. However, that's not the case. We'll dive into it in a second. We can see that the total revenue quarter over quarter is somewhat stagnant as well, which isn't alarming. It's not too concerning, but we want to see at least some growth quarter over quarter, which we are seeing around 8%, 3%, 2%. So that's a good sign. However, if we look at the net income quarter over quarter, we can see that they're reporting unprofitable quarters, which is very concerning for a stock like Alibaba. Right now, the stock market's favoring total net income over everything. And if we can see that the growth story just isn't there on the net income. So that's what's a little bit concerning about BABA for a lot of investors and why it's trading at lower valuations is we really need to see that profitability kicking in. All right, 2022 was the worst year at 32 billion in net income. This year, 2023, we saw closer to 73 billion. So that's a very good thing. Obviously, they're still extremely profitable and they're still making a ton of money. Every quarter they're making around 20 to 40 billion dollars in net income. It just gets really scary when we see those negative quarters like negative 21 billion, negative 18 billion. That's a huge red flag. And if we see consistent quarters like that, that's going to be a sign to get out of the company. However, right now, I think it's a good investment because they're a growth story that could definitely turn around and become very profitable with the revenue that they are producing. They're producing around $200 billion in revenue every quarter, and they're getting around 10% of that as their net income. So not the best in the world. But this is also why I feel pretty safe investing in Alibaba stock. It is because their balance sheet is extremely healthy. It's even healthier than the last stock that we talked about, Disney, and Disney had a pretty healthy balance sheet. However, BABA takes it to the next level with $1.7 trillion in assets, which is almost hard to fathom. However, they do have 630 billion in liabilities. So it is a lot of liabilities, yes, but the assets are astronomical with a 35% debt to asset ratio. As an investor in Alibaba stock, this gives me a very good feeling about, a very good sense of security about them being unprofitable here and there, a quarter every now and then. Okay, because the balance sheet, they have the cash, they have the assets, they have $1.7 trillion in assets, so they could burn a few quarters if they really had to. However, we shouldn't see them any more negative quarters moving forward. We should see only profitability here on out. So it could be a good idea to be investing in Alibaba stock around these times. However, you have to take all the risk scenarios into play with something like Alibaba because they're not a US based stock, they're a Chinese based stock, and that comes with a lot of extra risks involved with that. Now, their forward PE ratio is as low as 11.68, which is absolutely bonkers and mind-blowing to see Alibaba's forward PE ratio that low. PB ratio is 1.7, price to sales 16. So overall, a great deal. There is just some risk with Alibaba, but I think the risks versus reward under $100 per share is definitely worth it. But personally, I like to pick up shares closer to $80 per share, by the way. We can see what analysts have to say about BABA. There's more upside potential than Disney and less risk than Disney, at least in the analyst's opinion. We could see on average there is a $142 price target in the next 12 months, which is a 43% upside. We have $180 per share as the high point, and we have $98 per share as the risk for BABA in the next 12 months. If we scroll down, we can see that not a lot of analysts even gave their opinion on BABA this earnings season. We can see some 5-star analysts weighing in at 130 per share, 180 per share, 115 per share. So in my opinion, it's a very risky stock, but the reward could be there. Right now, it's at $100 per share. Even if we see Alibaba at $120, $125 per share this time next year, that'll be a 25% gain on the stock in the next 12 months. And I'll tell you, I would not be upset with that. So I hope you guys really appreciate this video, and if you found value in it yourself, reward me with a blue thumbs up. Just hit that thumbs up button. Share this video with a friend if you think that they can get some valuable information out of it. And if you want to join my close friends list, my private trading group, where you can see all my stocks I'm buying, when I'm selling, option trade, strike prices, expiration dates, and everything in between, click on success number 9 on the highlight section of my Instagram and read through some of those positive testimonials. Now over 1,000 success stories, and I want you to become the next success story. So message me here on Instagram. Now over 207,000 followers, 804 posts, and let's build some wealth together in the stock market. And you don't even have to be that experienced. Okay, these are signals you can follow along with. I give you an alert exactly when to buy, how much to buy, and when to sell also. So I take the stress and the not knowing out of when to buy and where to buy. It's all automated for you through alerts. So I will say thank you guys one last time in this video. Thank you so much for all the love and support that you have been showing. And I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.